bit. Let's talk about trade, and Investor talk a little bit about the new trade agreements, the negotiations with India and Japan, etc. But let's talk about some of the trade agreements that are happening outside of Brazil, which are pretty much going to impact Brazil. Specifically, I wanted you to talk about the phase one of the U.S.-China agreement. How is that going to affect especially the Brazilian ag business?
Well, there's winners and losers in every battle, and Brazil came out a winner in the trade war between the U.S. and China. Specifically, of course, because China had slapped tariffs in a tit for tat on the U.S. and the U.S. exports to China ag products, specifically soybeans, which Brazil is a major exporter, and for which of exports to China comprises 75% of Brazilian exports. So that was a big chunk, right? I mean, if 75% of your exports to China are soybeans, and suddenly the U.S. stops not stops, but almost. I mean, the U.S. exports to China of soy dropped about a third over a year and a half's time when the trade war started. And Brazil ate that up. Brazil was able to export far more to China, and that was a nice boost, especially counteracting some other headwinds for GDP. So getting to the point, phase one, great for the U.S., great for the globe, and therefore good for Brazil. And I think your central bank president said this as well. He said, look, it's going to hurt some ag products, for sure, because the commitment of China to the United States in phase one was to increase immediately agriculture imports from the U.S. by 40 billion. That's got to come from somewhere. It's more likely than not going to come from Brazil, because Brazil has now, this year, overshot the U.S. as the world's biggest exporter of soybeans. So that's going to hurt on the export front. The good news is that it helps the world, and Brazil is opening its economy and is exporting more globally. I don't think that's going to offset the drag that you're going to get from exports, especially because imports are rising. So remember, when you have GDP, you have consumption, you have investment, you have exports minus imports, and you have government spending. That's what comprises GDP. So trade is going to be a drag this year. And trade is going to be a drag, but consumption and private investment are going to finally contribute to GDP. And that's because, as I mentioned before, you have very low real interest rates. You have formal job creation that's doing very, very well. And you have oil production, which has been rising at a nice clip. So in the net, I still think Brazil is going to be the best performer in the region, regardless of the fact that they're going to, not enjoy the benefits of the trade war. But in the net, Brazil this year, I think, will grow 2.5%, better than last year. And we'll be on the road to the upgrade, which I agree with Oscar is less relevant now, especially for real investment, but is still relevant for portfolio investment, which is where I come in. So I used to work at an insurance company, and the insurance companies, they say, we have buckets, so by rating. This is where it's still important, buckets by rating. So we would max out Brazilian exposure. Max it out, we want everything we can get. We want all fixed income paper we can get, because Brazil's a great story, it's an improving story, and because it's on a rating trajectory that's upwards. When that started to go south, and it looked like Brazil was going to lose its investment grade rating, that was a huge deal, huge. So my old firm started selling positions, started selling fixed income bonds, expecting that downgrade, because once you move down the rating ladder and you go from investment grade to junk, they call it junk, which Brazil unfortunately happened to it, there's forced selling, because you have to have a certain percentage in investment grade. You have to have, and if a sovereign nation moves to junk, you're going to have to sell. So that was foreseen, and guys start to sell. This year, emerging markets are the top consensus trade. I do not like being in consensus. I tend to be a contrarian investor. But this one, I jump on the bandwagon. I think emerging markets are going to do very well this year. Brazil is growing. It has a very low Selic rate. And central banks are going to keep interest rates really low. So if you can put your money in Europe and you have to pay the Germans to have the honor of holding their bonds, because effectively you do, right? The entire German yield curve is negative yielding. So that means if I give my money to the Germans, I have to pay them when my bond comes due. It's a negative interest rate. In the United States versus Europe and versus Japan, it's not negative, it's slightly positive, but the 10-year treasury yields 1.5%. Right? The 10-year bond in Brazil, granted, spreads have come in, but you get 4 times that. So in a world of very low interest rates, emerging markets are going to do very well this year. The real, that's at 420, if I'm not mistaken today, will appreciate. My forecast is for 370 by the end of this year. And that's going to be because of a flood of investment. We already see it year to date.
Ladies first, I guess, Kathryn, yeah, if you want to.
Well, thank you very much. It's a pleasure to be here. Thank you, Surli, for having me as a speaker. And I'm so excited to be here today and talk about Brazil because it's the best story in South America. It's the best story in South America. And I don't say that to ingratiate myself amongst a bunch of Brazilians, or majority Brazilians, but in fact it is. So I'm a market economist, so my background is in macroeconomics, and I advise institutions, so pension funds in Latin America. So the idea is to make money, right? The idea is to make money for our investors. So what I've been telling them is that pension reform is absolutely critical. Without it, Brazil would have received a downgrade. With it, Brazil is completely steered clear of any downgrade and is on an upward trajectory in terms of credit rating. Is it sufficient? Absolutely not. It's not even sufficient, ladies and gentlemen, to keep the debt trend at its current pace. Insufficient to even keep public debt to GDP at the elevated ratio it currently is. It's at 80% of GDP. It's one of the highest in Latin America, if not the highest. Not enough. Great start. And I'll commend the president and his administration for not only that success, but many successes. Deregulation, of course, pension reform, and really being very open to markets. What needs to happen next, and I'm sure we'll get into this a little further, and I'll close here. 2 things. One, the administrative reform. We have to get that done. We have to get that fiscal emergency reform done. But by far the most important, and the ambassador, I think, just perfectly alluded to it, is tax simplification. There is no place as convoluted by the World Bank standards in the world than the tax code system in Brazil. I know it's on the docket. I think, as a market economist, that if President Bolsonaro is successful in passing tax reform simplification, it will define his presidency. It will make him a complete and utter success, and it will put Brazil, I think it will change the roadmap for Brazil. Thank you.
Thank you, Kathryn. On this side, if you want to understand, if you want to take that one. Yeah. Global ratings. I asked her what kind of homework the new Brazilian administration at the time will have to undertake to see improved credit ratings. And she said the pension reform was a good start, but might not be enough to see any significant changes in credit ratings. So far, she seems to be right. However, just a few weeks ago, S&P revised Brazil's outlook to positive from stable, and it cited the government's continued implementation of measures to reduce fiscal deficit. My question to the panel, and Kathryn, if you want to start again, is what does that mean for 2020? Are we going to see an upgrade? Does it go back to the tax reform and the need for more reforms?
Sure, and Lisa I know very well as the head of Fitch, who's Shelley Shetty, and I recently had lunch with her as well, so I can give you the Moody's viewpoint and the Fitch viewpoint. They're not going to make any moves on Brazil this year at all. None of the majors are going to be moved. Outlooks are different from upgrades. So an outlook, of course, means that there's a high probability of a move over the course of the next 18 months. but that doesn't necessitate that it'll come this year. In fact, I don't think it will. They're actually very negative on Latin America. The rating agencies are very, very negative. It's the region of the world that has the most negative outlooks by the rating agencies. And it's because the region is mired in low growth. Brazil is not an exception. Since 2017, Brazil's growth has been only 1.7%. That's very, very low. Potential growth for a country of Brazil's magnitude and capacity is 4.5%. So Brazil is mired in slow growth, which has not been helped by the external environment. I think what can help Brazil get out of both slow growth and receive upgrades is to continue the current path, which is low inflation, record low Selic rate, right? The Selic is at 4.5%. The real interest rate, which is inflation minus the Selic rate, is 0.6%. That's the real rate of interest. What does that mean exactly for us? That means that credit is cheaper. That means that domestic demand will continue to pick up, because domestic demand was in fact the biggest motor of growth in 3Q of last year in terms of the GDP. So Brazil needs to continue with the current reform framework. I sound very bullish. Brazil, I am. I am concerned that reform could get blunted. The reform momentum has to continue. Because if you get tax reform, you're going to open the floodgates to FDI. You're going to open the floodgates. Probably a lot of you know these, but for those who don't, just to put this in a frame of reference. In 1 year, a mid-sized firm in Brazil spends 2,000 hours working on its taxes. That number in the United States and UK is 100. Okay? So I think that if you get reform momentum, I'm not saying it has to happen this year. It's not going to happen this year. My concern is that it could get pushed further back. I'll take it as a positive, even if the president and the administration start to get the public understanding and comprehending the magnitude of change that it could elicit. If they could just understand how important it is to cut the fat in the public sector, right, and to simplify the tax code, then we could get broad-based support like we got for the pension reform. Pension reform, sorry, but everyone expected it. It wasn't a market mover. No one frankly cared, because you know what? It was so direly required that its passage was a foregone conclusion. Had they not passed it, it would have been catastrophic for the country, really.
Well, the market did react before, because it started saying, oh, it's going to happen, right?
So when it happened,
yeah, I understand. I have actually a view on ratings, right? So I'm not sure what they are used for anymore nowadays, truly, because either it's a big fund that will only invest in certain rates, countries. But if you look at the Brazilian CDS, it's now is tighter than when we had investment grade. And I think the more sophisticated investors who will drive the FDI are no longer taking that much into consideration. And unless it's a development bank or somebody that needs that kind of a stamp for it, I think for us, they are investing locally there and looking for FDI, looking for opportunities. They're going to have more capital. I think at the end of the day, it's a mixture of what's actually happening there. I really don't know the angle on the rating agencies for that matter. I would be a lot more worried about what are the price sections, where are we seeing those spreads going, what's the hedge. Nowadays it costs so little for it to hedge the currency, which was a big issue when everybody was investing about 5-6 years ago. It's like your exposure, you can't really hedge, it's too expensive. Now it's cheaper, so I think we're going to start seeing a lot more flow of capital towards the private deals because of that. But just to one point that I think Alexandre mentioned, right? There's some sectors, especially as a reality.
If I can jump in, I think a couple things are really interesting here. I love hearing from the real economy guys. I love it. Like what you were saying about logistics, it's fascinating. I mean, you're more of a long-term person, I'm definitely short-term. So I look at investments over a 12-month time horizon, unless the client cares about longer term. But I couldn't agree more with the infrastructure. That's the most severe bottleneck for long-term growth in general. And I'll actually agree with you too, Oscar. I think that private markets are definitely going to get more juice. You're definitely, by juice, I mean you're going to get more return. There's more arbitrage opportunities. There's more opportunities to capitalize on dislocations.
To leverage also the credit so
With
low.
regard to the public sector, and the reason why I like BRL at 370 is because 420 is so massively, massively undervalued. I'm talking about an adjustment to fair value. That's all I'm talking about. It's massively undervalued. The fair value of the BRL is actually around the 385 range. It shouldn't be trading where it is. The reason it is trading where it is because of central bank manipulation. I'm going to try to keep my comments short. But Alessandri, I think you are right. You are dead on with regard to the political risk. I'll name two risks that I think are very big with regard to public markets in emerging markets and in Brazil. One, his name is Bernie Sanders, and we're going to know on Monday if he's the candidate. Two, our central bank intervention. I'm not joking here. It's a massive bubble in fixed income. Massive bubble. I don't know if you all know this, but 40% of the bonds in the world are negative yielding. Bonds shouldn't be negative yielding. They shouldn't be. The ECB, instead of undoing what they've been doing for the past year, what have they been doing? They increased purchases of bonds to keep the rally going. That's called quantitative easing. What did the ECB do instead of forgetting it and giving up this exercise that hasn't worked? They took their overnight lending rate, which is a punitive tax on banks, pension funds, and insurance company. What they did was they said, okay, negative 50, it's not working. Let's take it to negative 60. That's a tax on banks. It's not working. So what we're doing is doubling down. My fear is that monetary policy is viewed as the panacea for everything. I think Brazil is the perfect example of what the world needs now. No one's talking about it. I'm a supply sider. I think that supply side reforms are where it's at. That's why I love the Bolsonaro regime, and I think Trump has done a fantastic job on the economy. Deregulation, tax code simplification, getting the government out of the way. Red tape, bureaucracy, try to cut down on that. Growth will take off. So what we're seeing now is none of that except in Brazil. Brazil's the only place that's really doing it, except for, the US had tax reform. If we get Bernie Sanders winning both Iowa and New Hampshire, he will be the nominee. If Bernie Sanders is the nominee, risk assets are going to drop 20%. Okay? If the S&P drops 20%, forget about the BRL at 370. Okay, that's not going to happen. So under my benign scenario, where you get, ideally, from a market's perspective, a Trump re-election. I don't think it's the base case scenario. It could happen, but if you get either a Trump re-election or a Biden, which is the least worst of all the socialists, then the market could continue to move higher. But if you get Bernie Sanders, who's a self-declared socialist, who, by the way, I'll give you if there's any doubts here, I'm going to back it up with numbers.
Lots of doubts.
Great. So the market's S&P 500 has a market cap, right? The market capitalization. 50% of the S&P 500 is comprised of three sectors: financials, healthcare, and tech. Financials, healthcare, and tech. The market is not pricing in either Warren or Sanders' platform, which includes the return to Glass-Steagall, which the president can do via executive privilege, does not require congressional approval, which is division of banks, dividing the banks. That's why Jamie Dimon came out against Elizabeth Warren. No one has touched Sanders. Why he came out against Elizabeth Warren so aggressively. Mark Zuckerberg also came out aggressively against Elizabeth Warren for the same reasons, breaking up of the tech firms. There are 5 tech names comprise 25% of the S&P 500 now. 25%. Okay? And then in the third place, so I talked about banks and healthcare. Okay? Nationalized healthcare. Okay? I mean, as a market economist, it's my fiduciary responsibility to make money for my clients. If there's someone that's going to come in and nationalize healthcare, I have to recommend a short position in healthcare. So what I've been recommending, just to put it concretely, is put options on the S&P 500 with March expiry. That covers any Fed mistakes, and that covers New Hampshire, Iowa, and Super Tuesday. Because my firm, and you can take this to the bank for next week, my firm conviction is if you get a Sanders or a Warren nominee, the markets will fall. And if it looks like they're going to win, they're going to fall further. So that's my view.
Thank you, Kathryn. I'll try to get away from politics for a minute. Kathryn, do you have any comments before I open up
Sure.
questions?
Yeah, again, we have a different point of view because you're private and real economy and portfolio hot money flows. But I do think that I understand what they're saying, and I think Brazil is back in vogue just because risk appetite is back in vogue. Why? Because in December of 2018, if you all remember, the S&P dropped 20% and everyone was talking about recession. The U.S. was going into recession. I mean, I got asked by everybody, clients, TV, anybody, what's your probability of recession for the U.S.? 40, 50, 80? What kind of question is that? So recession is, we said it then, my firm, we said no recession, but back then, emerging markets was out of style. No one wanted to talk about emerging markets, not if we're talking about U.S. recession and trade war. Remember, trade war was going to throw China, the U.S., and the globe into recession. That was December of 2018. So now that the market has completely priced out recession, you won't hear one economist talk about recession this year, very few even next in the U.S. economy. And now that we've had phase one with China worked out and USMCA passed today in the Senate, there's risk on. Now, the central banks have manipulated the public markets to such an extent that you have interest rates either negative or on the floor. And then what has smart money done? They've maximized the S&P 500, which is every day making new record highs. So they max out that. What has picked up the slack? Emerging markets. Emerging markets have pulled up the rear. So now all the money is pouring, it's like a waterfall, you know? So you max out fixed income, you go into US equities. Europe did phenomenal last year, even Europe. Now we're looking at emerging markets. So yeah, I do think Brazil is back in vogue, and emerging markets, like I mentioned, I don't like being in consensus, but everyone is long emerging markets this year.
If I may add just one thing related to Davos. Davos, the whole focus there of the team, and I have some good friends that were there, was to promote privates, right? Promote a flow of money to come to privatizations, to come to inflow infrastructure and all of that. And then when you think about what do you want when you want to invest private in a long term into a specific country, you want low inflation, low interest rates, maybe a weak currency as a good entry point. And for that matter, we've never had such an ideal moment as we have in Brazil today. And with the momentum of political reforms on your back, showing like, look, we've had social security reform, we've had labor reform, so things are going on that track. So I think Brazil is definitely back on the private investors' mindset, which have not moved because FDI started just moved just very recently. So I think on the public markets, maybe it was back already in early 2019. People started like top pick was emerging market bonds and equity. But I think now is the moment for the private investments, and I think that's the word in Davos, the word from Davos.
Thank you, Oscar. We're running a little late, so we have room for 3 questions.